Apple is obviously known for consumer products. In my opinion, their mobile and work-related products has really put them on the map. For the past decade, they've also been making a ton of money in not so obvious ways. And now that they're doing a split, there is a whole new reason why you might want to consider investing in them. So let's talk about how Apple might fit in your portfolio for the next 2 to 3 months. If this is the type of content you've been looking for, please hit the like button and let's get started. Hey everyone, Steve here from 11ish, a channel where we talk about lucrative investment strategies and opportunities based on the requests from the 11ish collective. Today we're going to talk about Apple. There are 99 reasons why you might want to invest in Apple, and Gen 1. Apple's valuation is more than most countries' GDP, and yet its PE ratio is only 35. Apple has hoarded almost $200 billion in cash. So even if the shit hits the fan, it's going to outlive the cockroaches. Apple has religion-like brand love, and this is why they have an ecosystem that is worth so much money in terms of year-over-year upsell opportunities, subscription services, and so much more. An apple a day keeps the doctor away. Speaking of ecosystems, Apple has so many good products that are premium, but quality-wise, they're justifiable for the premium in that all of their upsells, all of those additional services are valued at more than $500 billion themselves. This includes storage, all of the apps, music services, Apple TV. Now that Apple is doing a stock split on August 28th, you swing investors, there is almost a guaranteed investment opportunity for the next 2 to 3 months. Objectively speaking, a 4-for-1 stock split, all that means is that if the stock price is $400 after August 28th, each share will be $100, and if you already own the share, you will have 4 shares. So intrinsically speaking, the stock value does not change. What does change though is that if you are investing in, let's say, the Dow ETF, that's effective because the Dow is based on the weighted average on the stock price. If the stock price is a fourth of what it used to be, in this case for Apple, the relative weight of Apple affecting the Dow's overall performance will be affected. However, we know the stock market is filled with emotional retail investors, especially during this time period where there's a lot of gamblers in the market. What's most likely going to happen is that the investors who are looking for cheap stocks are now suddenly going to invest in Apple. The idea here is that if I'm an investor who only has a few $1,000s to invest with, and I look at a stock price of, let's say, $500, then I'm looking at it and thinking I can only buy 7 shares. I'm not going to invest in that opportunity. But if the stock price is a fourth of that, then my willingness to pay is much higher because my perceived gain is higher, even though we veteran investors will look at it exactly the same. 5% gain is the same regardless of whether you own 1 shares of $3,000 versus 20,000 shares of $3,000. But that's just not how a lot of retail investors think. Therefore, the stock will go up temporarily. The reason why it's temporary is because there is a ton of institutional or professional investors in the market, and what they're going to do after the stock price gets kicked up is that they're going to say this stock is overvalued. Based on the numbers I've crunched, this stock is worth a certain price. Now that the stock price has gone up, I need to sell, and that's going to drive this price down. In which case, once the price is down, the stock is going to move once again based on the fundamentals, the business value, and etc. etc. So that gap right there, which doesn't always play out that way, but many times it does, that is the investment opportunity that you swing traders are looking for. The only serious risk or the wrench that might be thrown in your way is the fact that we are in a very precarious time where COVID is very unpredictable. Unemployment is going up, right? And so because Apple is basically a premium product that costs a lot of money and the price continues to go up, the challenge is to think about whether people will continue to buy Apple products. Because in my personal opinion, there's going to be a certain point where people are going to back off and buy a more affordable option. If that happens, what's going to happen is that all of the upsell opportunity on Apple's ecosystem, cloud storage, music, etc., that usually pairs very well with Apple products, suddenly may not look so hot. And so it will create a cascading effect of revenue loss if that happens. Only time can tell what the ripple effects are for people losing their jobs, being furloughed, getting stimulus check to just pay for the bare minimums. Me personally, I think that this stock split is a great investment opportunity. It's a very, very short 1 to 2 month kind of thing. But going forward, because I think COVID is dramatically underplayed and that the stimulus package and the unemployment is going to just get worse, and I am super concerned about the ripple effects that are coming up, I will not hold a stock like Apple for the long term because I'm expecting it to drop, and then that in itself will create an investment opportunity if you choose to invest in Apple. When a company depends on retail products this much, it makes me very, very hesitant, and I just think that there are safer opportunities with good enough upsides for me to invest in. But I would love to hear your feedback. What are your thoughts about investing in Apple right now and in the next 3 to 6 months? And how do you view Apple as an investment opportunity? I would love to hear your feedback. And if you have any questions, concerns, or suggestions for what you want me to talk about next, please hit that subscribe button if you haven't already and leave a comment. I would love to open a dialogue with you, and I look forward to working with you next time. Thanks for watching.